Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
If you're not very comfortable drawing trend lines, you can always use a line that actually measures the average price of the last X number of bars. You can pick the number. I happen to prefer 30 and 10 for my weekly charts, and I kind of use them on intraday charts too. The moving average will provide clues as to the direction and the strength of the trend. It's a very useful indicator for a trending market. You can also use something called an oscillator. An oscillator kind of measures the rate of change or the momentum of price. So if price is actually moving very quickly, an oscillator, of course, will show you that movement, almost like the speedometer in your car. The harder you step on the gas, the bigger the speedometer moves to the right. And one of these oscillators will show you that movement too. It also can show you something called divergence, overbought and oversold conditions. Divergence could be the indicator going up while price is going down, which we consider to be positive. Probably means the selling pressure is leaving a little bit. Or you could have what we call negative divergence, where your uptrend is moving up in price, but your indicator is moving down, which means that there may not be enough momentum to sustain that trend. Sometimes that indicator can be useful for trending markets as well as range-bound markets, but the overbought and oversold conditions are what we primarily use oscillators for in trading ranges. So on this particular chart, first of all, I have moving averages. When I have flat moving averages, it probably means I've got some kind of a channel, and that means there is no trend. Here I have a cross of my faster 10 over my slower 30, which we call a bearish cross. And when I break through the support here on the channel, I begin a new downtrend. And of course, since this is a downtrend that we're looking at, this is a perfect time to use this type of indicator. I've got another period here where I go flat and I start to trade sideways once again to where my moving averages flatten out, and then another cross and another downtrend. And here's something that you can do. If price happens to rally to the 10 but stays below the 30, this gives you an opportunity to short rallies, these little counter trend rallies, in this downtrend. And as long as price doesn't close above your upper moving average, you have the opportunity to stay with that trend as long as it wants to continue. But once we have a crossover here, a bullish crossover, pretty much ends this downtrend, just like a bullish crossover here pretty much ended this downtrend. And so we're just about to have a bullish crossover on this 4-hour chart of the dollar versus the euro. And that's another signal for somebody to join a possible new uptrend. Okay? So, trending indicators, moving averages. Here we have buying a pullback to a rising moving average in an uptrend. Okay? So there's an opportunity to use a pullback as long as price doesn't close below the 30 moving average to buy a pullback to a moving average in an uptrend. Okay? Here's our oscillator, which is our trading range indicator. This is something called a slow stochastic. I have a stage 1 accumulation phase, which means I get overbought when I get up to the top of the channel and I get oversold when I get down to the bottom. So I have the opportunity to use these signals to enter trades here. Okay. I broke out of my stage 2 or into a new stage 2 at this point, and then I had a little bit of a retracement here. And when I had that retracement, here's an example of using an oscillator correctly. In a new uptrend, here's an opportunity to take an oversold signal to buy a pullback to a trend line, to a moving average, to whatever kind of indicator you want to use during the context of a possible new uptrend. But what you need to do is, in an uptrend, you need to ignore these overbought signals. They won't help you. And in a downtrend, you've got to get used to ignoring oversold signals. So you need to know which stage of the market you're in to make this a useful tool. So we're going to review some of our currencies now, starting with the dollar CAD. The dollar CAD from back in August of last year to where we are currently. It's one of the commodity currencies, which means the value of the currency is actually tied to the exports from the country. Canada exports raw materials such as oil, precious metal, copper, and zinc. So their currency is not like the U.S. currency, which is pretty much just tied to the full faith and credit of the United States. Okay. So similar currencies would be the Aussie, the New Zealand, and our new British Real. So from September of 2009 to April of 2010, the dollar has been in a pretty much of a bear market against the CAD or the loonie. And during this downtrend, though, we've had several long trading range situations. There were large limit buy orders at certain prices that needed to be absorbed before price could go lower. And every time we hit these buy orders, we had some strong intermediate or counter trend rallies. So this is a currency that's in a sideways to lower trend. And there's many periods here on this chart, starting in August last year, to where we went sideways for a period of time, such as this one here. And on our weekly chart, we were trading between daily support near 107 and daily resistance near 111. However, I note on my chart that the primary trend is down. Once I broke out of here, I began a stage 4 decline. Once I closed below this 30 moving average, that indicates that I am now in a stage 4 decline. I have an indicator called the relative strength down here, which you're actually going to have a great webinar about next week. So you can use that oscillator for overbought and oversold conditions. And you can also use that indicator to kind of tell you when it looks like this market is actually going to resume the downtrend. So I'm sure that that'll be covered in great detail. But just a couple of indicators on this chart. Here, of course, when I'm in a trading range situation, it's an oscillator that gives me oversold signals, overbought signals, and a lot of times that's good information. Okay? But when I get to my daily chart, I can see that I had support between 107 and I had resistance at 111. And so I had this multi-month trading range situation starting in August through September. There's an example of an intermediate turn counter trend rally up right into some resistance for a shorting opportunity if you like to sell strength. If you like to sell weakness, you can draw your trend line and take the break of the trend line to join the downtrend here. Now notice the distribution pattern that's forming here. I've got large buy orders to buy here. And each time I come down here, I absorb those orders and I go lower and lower. At the same time, every time there's a rally, sellers are selling at lower and lower prices. So this is what we mean by sideways to lower. Even though this trading range lasted from August through October, you could see that there was this distribution pattern with sellers selling at lower and lower prices. And finally, in about the first week of October last year, we began our new leg down. So when the last buyer buys, price starts moving lower and new trend move. And now we have a descending triangle here, or we could say we have a horizontal trading range situation with a breakout to the downside, which we call distribution. And we came down to this next support area over here, which was from October of 2008, right before the big rally. And so we once again found a little bit of support for a period of time. And as you can see on the next few slides, we actually had some nice counter trend rallies out of here for a period, but we had some resistance overhead. And so in 1017, the potential trading range was actually between 101 for support and 109 for resistance. But then it ended up being a new resistance area at 108 and a new support area here at 103. When this weekly candle closes above here, this becomes a new support area that we can use in the future.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.